All right, welcome to episode 7, of the Foundation to Fortune podcast. I have to look up on the screen and make sure I got it right. So, but we are glad to have everybody here. Appreciate all those who have been watching on whichever podcast service you subscribe to. So, we appreciate comments back and those that are listening and commenting and watching. So, we are excited today to have Amie Gray with us. She is with Eisner Advisory Group, and we're going to be talking a lot about affordable housing and LIHTC properties, which is, a lot of people, even investors, have no idea what that is and all that good stuff. So, but to kind of start, Amie, tell us a little bit about you and who you are and all that good stuff.
Sure. My name is Amie Gray. I work for Eisner Advisory Group, which used to be known as Tidwell Group. We were acquired by Eisner in May of 2024, so I'm still getting used to the new name. I have been in affordable housing my whole entire career, so almost 20 years. I specifically only work in affordable housing, and I work with developers, and I help them build affordable housing with LIHTC, which is low-income housing tax credits. So that's my specialty. And within that space, I specialize in year 15, and within that is, qualified contracts, which is what we're going to talk about today. But in year 15, the LIHTC program has a 15-year compliance program or compliance period. And once that compliance period hits, that's when a bunch of options come available to owners, and I help the owners navigate that space.
Yeah. Excellent. So, and she said she's been in this for how long?
Almost 20 years.
So she started when she was 5.
Exactly.
Just to let everybody on here know from that standpoint. But so, Amie, so you grew up in Ohio, is that right?
Yep, born and raised.
Born and raised, Ohio. Yep. You live just outside of Chicago, an hour or so.
About an hour outside.
Yep. And previous to that, you were in Atlanta for a few years.
Yes, sir.
Yeah. So, and my understanding is you want to move from Illinois.
Yes. Not where I want to be, but that's fine. It's where I am. So.
Right. For now. So,
yes.
Yeah. And so I got introduced to Amie by a local investor, and actually Brandon Thornberry, who has been one of our guests on this podcast, and he had spent time, I think, about 45 minutes talking to you.
Yep.
And as soon as he got off the phone, he called me and said, "Brian, you need to call and talk to this Amie Gray, because I just spent 45 minutes talking to her about affordable housing, about LIHTC, and I think I maybe understand maybe 2% now, but." But he said, he was like, "Wow, what an expert, what a person with incredible knowledge, on affordable housing and LIHTC." And myself being a broker, LIHTC properties are not ones that I have experience with, and so I was like, "Hey, I appreciate the introduction," and so then Amie and I kind of. We exchanged some emails, and then we had I think Amie was very kind because it was supposed to be about 30, 45 minute conversation. I think it ended up being like an hour and a half.
I think so. Yeah.
Yeah. It was a good
conversation.
Yeah. And so I'm like Brandon, I maybe know like 5% maybe of I just wanted to do a brain dump from you to
well, hopefully
to me.
you'll understand 7% today.
There you go. So we're going to try to get a little more today.
Yeah,
so, but really appreciate it, and I appreciate the introduction.
Absolutely, I appreciate Brandon introducing us. We had a really lovely conversation, and I think by the end of it, he said, "Wow, you're really smart. I'm going to introduce you to Brian."
Yeah, and I agreed with him there.
Well, thank you.
That's for sure.
Very flattering.
Yeah. So let's talk about how you kind of got into your career. I think if I remember correctly, right out of college, you started with a CPA firm.
Yeah, sure. So right out of college, with just my associate's degree, I interviewed with a CPA firm. I didn't realize that they only specialized in affordable housing, but that's where I found myself and I was hired. And then, the rest is history as far as staying in affordable housing. I couldn't imagine doing anything else. I stayed with him for 8 years, and then I went to work for one of our clients who is a real estate developer. And I did that for 3 years, where I was boots on the ground developing apartment communities with the company I worked for. And then after 3 years, the same partner out of Ohio that had his own firm, he joined Tidwell Group. And once I heard that, I called him up and I asked him if he had a job for me, because I wanted to work with developers across the country, not with just one developer in 2 states. So he said, heck yeah, I do. Come on over. So I did. And I guess the rest is history from there. I've been with Tidwell Group / Eisner ever since, and that was in 2018. So for the last 7 years, I've been helping owners in the year 15 space. And we also help a little bit on the front end of things and getting tax credits allocated. So we have a whole span of services that we offer.
So I think it's awesome. That's kind of the story of that, because it's really given you the experience of kind of both sides, right?
Yes.
Of helping them as far as working with them from the CPA side of it, but then on the development side to see, okay, how these developers go about it, how they build it, using the tax credit. So so you're well-rounded in all of that, because you have the experience of both sides.
Sure. Yeah, and that's actually was the reason why I wanted to go work for a developer, not only because I wanted to help build affordable housing, actually be instrument in doing that, but I also wanted to have the full experience from each side of the table. I wanted to know how to wear the other hats that were required within our industry. The only piece I'm lacking now is the lender investor side of it, but I get enough experience with lenders, investors that I do understand that. But you're right, and that's why I see myself as valuable to our clients, because I can understand it from their point of view, but I also, obviously understand it from the CPA side and the compliance side.
Yeah, excellent. So let's talk about, when we talk about affordable housing, and then we talk about LIHTC, right? So
Yes.
a lot of people, and especially investors, and I know, even some more experienced investors don't really understand, when they think of affordable housing or they think of LIHTC, then a lot of times it may have a very negative connotation to it.
Right.
Right. So let's talk about, when we talk about affordable housing, how does that, how does that relate? How does it relate with LIHTC? Is it the same thing? All that,
Yeah, that's a great question.
Yeah.
Okay, so a lot of times when people hear low-income housing or affordable housing, they think Section 8,
Yeah.
which that can be a component, but that is not how our program is built. Our program is built through, for one, it was formed in 1986 by the Reagan administration, so it is bipartisan. It's supported by both sides of the table these days. And it was built as an indirect way of subsidizing building apartment communities. Now, Section 8 can be project-based or it can be tenant-based. And when we say that, that means if it's Section 8, if it's project-based, that means that the Section 8 goes on to that entire project. If it's tenant-based, that means the the individual goes to the state, to the local housing authority, and they get a voucher, and that's a Section 8 voucher. And they use that to pay their rent. So affordable housing, the way it works is the federal government gives out tax credits to owners, to developers. And when I say owners and developers, those are used interchangeably within my industry. So when we say, or when the federal government gives out tax credits, and you don't get them from the state, or you don't get them from the federal government, they give them out to each state, and then the owner applies to the state to get those tax credits. Now, those are given to the developer. Developer takes those and they sell them to an investor, because the only parties that can actually use those tax credits are a corporation to offset their tax liability. So
Okay.
so they they sell them to the investor for money on the dollar, for pennies on the dollar. I think right now it's about 85 cents to 95 cents, depending on the area that you're located in. In the past, if it's like a CRA or a credit reinvestment area that's, desirable to a bank, the credit pricing could actually go all the way up to $1.05, $1.10, which is wild.
Yeah.
But those days are gone right now. Those were a few years ago. But anyhow, so the owner sells them to an investor for money on the dollar, and then they use that money to build their property or to rehabilitate whichever type of tax credit that they received. And so that's actually how it works, because they sold them, because they use that free money to build the apartment community, they have to take out less debt. And because you have less, lower monthly mortgage payment, you can charge less rent to people. And the way the program works is, and it's historically, it was 60% of the area median income. Someone to qualify to live in that apartment community cannot make more than that 60%. But in recent years, they've actually made it where you can leverage or average that out to where it's anywhere from 20% to 80%, as long as it's averaged at 60%.
60?
Yeah.
Oh,
So
I did not know that.
yes,
So.
yeah. There's different elections that you can make at tax credit allocation, where you can predetermine the the skew of affordability that you're trying to create within your apartment community.
Yeah. Interesting. So, and you talked about you work all across the country.
Yes, I work with developers in every state, including Puerto Rico and in Hawaii and Alaska.
Yeah.
I'm not well versed in every single state's tax credit requirement, because it's the way the government has administered the program. They give each state their own way of allocating the credits. So each state determines who they want to give credits to, basically, and what locations they want to promote. So each state is incredibly different when it comes to tax credits. But so that makes it a challenge for CPA firms or consultants to, every time we get a new client in a different state that we haven't previously had a lot of experience in, we have to research and, gain an understanding of that state, pull on some professionals from within our firm, see if anyone else knows that state. So it is, it's very complex, and it's you're constantly learning new things all the time, every day.
Is legislature changing rules all the time, and so you're having to keep up?
Oh yeah.
Then you're not counting what the federal government may do or whatever. So
Right.
you're having to, your firm is having to keep track of all of that all across the country.
Yes. Yeah. And because we are a federally regulated program, what they vote on and the bills that they pass do affect us.
Yeah.
I will say our program is the most successful federally regulated program in history.
What do you attribute that to?
So because it's built organized in 1986, bipartisan. It's generated 3.5 million units of affordable housing since its inception in 1986, which is really insane.
Yeah.
It's, they keep increasing the allocations every year. And a lot of times, most of the time, the bills that do go in that are related to affordable housing, they usually have full support from all sides of the aisle. They make changes to the bills all the time before they approve them, but for the most part, there's not been very many bills in the past that haven't passed for affordable housing. Yeah. So it's supported by everyone.
So let's kind of talk about on the development side,
Sure.
Right? So, why would a developer want to build LIHTC?
That's a good question.
Well, I guess what's in it for them, and how do they per se make money? And because there'll be probably some developers listening to this podcast and are kind of like, I hadn't even thought about that.
Yeah. Well,
right?
For someone that is not in the industry, it can be difficult to enter into. But with that said, there are ways to do it, and I'd be happy to speak with those developers. But the reason why anyone would want to get into this industry is really for the humans, right? For the people that don't have affordable housing, and the people that is a right, each human should have access to safe and affordable housing. And so when I was a developer, that was obviously my primary goal was to create housing for people that needed it. And I'll say when I was a developer, I actually received letters from tenants because what we built was either for permanent supportive housing for homeless people with developmental disabilities and substance abuse problems. We also primarily built housing for seniors. And the seniors that would write us, saying that this is the first time they've lived in a house or lived in a community like that, during the holidays, and they all were able to get together and do gift exchanges and, the supportive services that we had at the community. Like we would have a bus to take people to groceries and, a bus to take people to get their hair done. We had all kinds of different supportive services wrapped around that community. And the letters that we got were just, they definitely brought you to tears. They were amazing. But so that's, I digress there, but that is the primary focus of most owners in getting in this industry.
Well, to see the impact that you're making,
yes,
and the difference that you're making,
it's incredible.
That is awesome.
Yeah, it's really great. And then you hear stories of the moms who, single moms with 4 kids that could never ever afford a market rate community, and then now they qualify for this housing, and it's brand new and it's beautiful, and it's they have a pool and a playground and all that stuff for the kids. So it created an environment for those kids to actually grow up within a safe environment. And then, not only does that benefit the mom, and I'm getting goosebumps from this, but not only does that benefit the mom, but it benefits the kids, because then you're giving them a safe place to go home to every day, a safe place to do their homework. They can actually most likely make something of their lives because they suddenly have this community to grow up in. So it's incredible.
Yeah. Brings the human story out
Yes.
in that stuff.
Yes.
Right. For tenants and to see, I think that is just great story.
Thank you.
From the overall human side.
Yes.
And I think a lot of people don't think of that.
Right.
Now this young child who may not go to the best school or whatever, but he's got a safe place. He or she has a safe place to come back to.
Yeah.
To grow up in a home, have some amenities with it that hopefully can teach them some life lessons.
Yes.
and all of that. And that's fantastic.
Yeah, and with the family communities, a lot of times, so as part of getting the tax credits, a lot of states incentivize supportive services for these communities. So a lot of times they do financial literacy. So they teach not just the parents, but the entire family how to actually survive financially, to budget, to all that stuff that doesn't just come, that isn't just in our brains when we're born, but we have to actually learn it, right? So, that's just a small example of one type of supportive services, but that's, and something that people might think of when they think of affordable housing is that these apartment communities are not beautiful or they don't look like market rate. The entire purpose of they're called QAPs, or qualified allocation plans. They're what dictate how the tax credits are going to be allocated each year to owners. And, they have so many requirements within that QAP that owners have to follow. It's so strict that a lot of times these apartment communities are actually built in better, with better materials. They have a better R rating, so they're more efficient. They're actually supposed to look like market rate housing, even though they're for people that, don't make a lot of money. So,
and the housing authority, do they have requirements? They come out and do inspections on them, and then they have to get signed off on all the time, right?
Yes. The amount of compliance that these owners have to go through that's probably one of the biggest barriers for people wanting to get in, to build affordable housing, because you are regulated for your first 15 years of owning the community. Each year they do 100, well, not every state, but each year the state does a compliance inspection, not only of, your tenant files to make sure that the people that live there actually qualified, but also they do a full inspection of the property to make sure that there's no, health or safety issues.
Yeah.
So, uneven sidewalks, cracks in the in the parking lot, things like that you'll get written up, and you could actually lose your tax credits if you don't stay in compliance with the state agency's requirements.
Yeah.
And to even get to the point where you can build one of these properties, you have to go through, various environmental assessments. You have to go through just a bunch of different hoops and things to jump through to even get to the point where you can break ground on these apartments.
Yeah, before we jump into other stuff, can you go back? Can you tell our listeners the story you were telling me earlier about Akron and building, and how building this affordable housing helped reduce the go ahead and tell the story.
Sure.
I don't want to get it wrong by saying anything, so I'll let you tell the story.
Thank you. Yeah. So when I was with a developer in Ohio, we were based out of Cuyahoga Falls, or it's near Akron. And we had built a few apartment communities up there, and I think it was a total of 120 units. And I participated in this building, but it certainly wasn't me. But we had fractionally ended homelessness in the city of Akron through building these two apartment communities, and then another developer who had built two very similar apartment communities. So through our 4 properties, we had fractionally ended homelessness in the city of Akron. Now that was in 2015, 2016. So I'm not sure if that still stands, but that was a really great feeling at that point, because
but that's the impact that you can have.
That's the impact that you can have, and that shows that our program really works. Yeah.
I think that's a great story.
Thank you. Oh, and the apartment communities specifically were targeted to people that experienced homelessness, had substance abuse problems, and had developmental and intellectual disabilities. So not only did we create 120 units, but the amount of services that we wrapped around those 2 buildings were just insane. I mean, there was full support staff on site. They did everything from counseling to helping with the substance abuse to administering medication. These properties are so involved. So
that's a great story.
Thank you.
Great.
I'm very proud of that
that's
team.
a great testimonial to what affordable housing, what the LIHTC program can do for communities.
Exactly. And that's what we all strive to, is to help the people that need it.
Right. Yep. So let's get into you're talking about working with developers or properties to get to that year 15. So what is it about that year 15, right? And let me, before we even get there, I'm just going to go back and one of the questions when I called to talk to Amie, and when Brandon said, "Hey, you need to talk to Amie," I was all about that, because as a broker, I'm dealing with mainly all market rate properties and all that. So the LIHTC thing was, I'd heard of it, so forth, but it was never something that I, as a broker, pursued with, find owners of these programs until in January when I went to NMHC, National Multifamily Housing Conference, out in Las Vegas. And out there as a broker, you're meeting with owners of properties to not only work with them to sell their properties, but also they're wanting to meet with you too to help them find some properties. And so usually you have 2 or 3 days of 10, 12 meetings a day. And I was telling Amie when we were talking, when we had our call, I was like, it was crazy the difference between 2024 and the 2025 meeting, and that this year in January, just 5-6 months back, at that meeting, those 3 days, there were probably only 2 people of all those meetings that didn't ask for LIHTC properties.
That's wild.
They were all asking for, like, and then I look at, you go the year before in San Diego, and out of those 3 days, there might have been 2 people that even mentioned it. Right. And so that's when it kind of got
topic.
on. Yeah. That's kind of when it got on my radar of, wow, maybe I need to learn some more about this property. And so I'm hoping to get 7% by the time we get done today.
Yeah.
But
An extra 2%.
yeah. So, but let's talk about the year 15. And you hear the term QC, and we'll go over a bunch of terms, and you hear Laura's. But then I also found out from talking to you that it's not every state calls it that, and all there. So let's get into some of the jargon and verbiage and what's important about year 15 and a lot of those things.
So within the year 15 space, there are a few different options that you have. And within that option or within that space, there's an option to elect your right to a qualified contract. Now, let me back up and be very clear. We talked about this before a little bit based on my experience as a developer, but I want to make sure everyone knows that I'm very pro affordable housing.
Right.
Because what I'm about to tell you sounds not pro affordable housing, but I'll get into why I think it's a great option.
And maybe even before we go there, so when a developer works with the housing, the state, whatever, to get these tax credits to go and build these, they are basically signing up for that property to be, under this program for those 15 years, right?
Okay, that's a good point. Let's back up to that.
It's
actually a 30-year. It's actually a 30-year extended use period is what you're agreeing to, and that's a minimum.
Okay.
A lot of times the states tack on years at the end of that or in the middle of that, but it's a minimum of 30 years, and it's broken down into 2 segments: a 15-year initial compliance period and a 15 years extended use period. So when I say compliance period, that's the first 15 years, and then extended use period is the last 15 years. But that's 30 years of affordability. And something that I didn't touch on earlier, when we say LIHTC versus affordable housing, affordable housing is a nicer way of putting it. We don't want to call it low income housing because it has a negative connotation.
Right.
So in my opinion, I think affordable housing is more, it covers the breadth of it.
Yeah.
But anyways, so after that 15 years is over, or actually in the last year of that 15 years, so on January 1st, an owner can actually go to the state and say, hey, state, I want you to market my project for 1 year at this price. And the state does that. If no one comes forward to purchase the property, then the LIHTC restrictions are, you get a partial release of those LIHTC restrictions. And so, like I said before, the restrictions for no one that makes more than 60% of the AMI, that's the affordability or the affordable restrictions that I'm referring to. So after that 1 year of marketing, if no one comes forward to buy the property, because if someone comes forward to buy it, then it has to stay affordable through the extended use period. So for that later, the 15 years or for the full 30 years. And at this point, it would be an additional 15 years because we've already hit, year 15. So if no one comes forward, that, you get a partial release, and then the restrictions are phased out over 3 years. It's called the 3-year decontrol period. If someone does come forward, then they either have to purchase the project, or if they don't purchase the project and it's to the fault of the seller or the current owner, then that property remains affordable. There's no option to take QC or to elect QC again through that tax credit allocation. So, you have to keep the property. So it's really important to do your due diligence, and if there's a reason why the sale is not going to go through and it's not your fault as the owner, then you need to go to the state and explain that and try to get the QC period to start back up, because otherwise the state's only obligation is to give you a buyer. They don't care if the sale goes through or not. Yeah. And that's the biggest risk that you take in trying to take a property through QC. I will say in Tennessee, it is a little more difficult than other states to take a property through QC.
Yeah. And why is that?
because the property values here are very high. And so the reason why properties get through this QC option is because the price that they're listed at, that they're marketed at by the state, is calculated based on a formula that was actually put out within IRC Section 42, which is the part of the Internal Revenue Code that mandates low-income housing. And so the way it's wild because I've seen some crazy calculations in my time, but it's a formula and it actually does not take into consideration anything that fair market value would take into consideration, right? So the way an appraiser values a property is totally different than the way that a QC price is calculated. There's a small, very, very small fair market value component, but that's just the piece of the land that the property sits on. But other than that, it's based on the equity that was used to purchase the tax credits and the debt that was used to pay for depreciable costs. So those are the two biggest components, and then there's a few other components to that.
Wow.
So the reason why people get through the 1 year marketing period usually seamlessly is because the QC price is so much higher than the fair market value that, you as a broker or any lenders, investors out there, they would know that a lot of times a lender is only going to give you 80% loan to value for your property, for debt. So if you can only get 80% of fair market value, and if there's a spread between the QC price and the fair market value of 10,000 or 10 million, then that means you have to come up with not only 10 million, but also, the 20% between your debt and fair market value.
So, and the state's the one that puts that price on it for that 1 year.
Yes.
Right?
Yes.
And that's why it seems like you see during that year, the price definitely goes up for whatever that property was or is. I mean, am I wrong? It seems like year 14, if, people are looking at, or getting that 15, whatever, they're looking at selling it, seems to be one price. Then if it goes into that 15 year, then all of a sudden, you notice the price had went up considerably because it's in that.
Because it now has the option to do that.
Yeah.
And I don't really I'm not really involved in that too much. I'm sure you've seen that.
Yeah.
But I will say, even if I don't know that it really matters in year 15 because, whether by the way, you can't really sell a property usually, depends on the state.
Yeah.
A lot of states won't let you sell a property before the tax credits are expended.
Yep.
And the investor won't let you sell either. So a lot of times these properties won't even sell until year 13, 14. There's certain situations where they do, but that's for the most part. But, because even if someone did buy it in year 13, it's still eligible in 2 years to go through QC if it is eligible. Because a lot of times states built into their QAP, their allocation plan, they built in point scoring criteria where if you agree to this, which by the way, you have to, otherwise your application isn't going to be competitive at all. Yeah. But if you agree to this criteria, you're going to get 5 additional points to keep the property affordable through 30 years. That's one example of what states have done. So they've used the QAP point scoring system to remove the QC option completely.
Yeah.
But in the state of Tennessee, you can still do it. In a few other states, you can still do it. States like Ohio, you can't do it unless you have a property that was allocated credits before 2005. Texas, it's before 1999. There's a few states that we know of that, they have hard deadlines for that. But anyway, so I don't personally see a difference in the pricing, whether it's year 15, year 13, 14, like I said, because ultimately they are eligible.
Yeah.
But I'd imagine that if you have, you're in year 15 and you get someone to calculate a QC price for you and you use that in your marketing material, pretty sure you can get a higher price for that. But that is a piece of it that you want to make sure there's a big enough spread between what you bought it for and what the QC price is, because if it does sell, you want to make sure that you make a return on your investment.
Yeah.
Right.
Yeah. Okay. All right. So I know, let's talk about, so what is a LoRa or whatever they call it in other states?
Yeah. Yeah. Okay. So LoRa,
because I hear owners of them saying, "Oh yeah, I'll send you all all the finance, everything, and then I'll send you the LURA.
Okay.
And I remember the first time I ever had the owner say that to me. I'm like, okay, great, send it along. I'm, in my mind, I'm like, okay. Well,
Don't know what that is.
yeah,
But okay,
I'll
cool.
read it when it gets here.
Yeah.
So
Yeah,
let's talk
so
about that.
the LURA is actually what governs, each property. And within that, and it's a land use restriction agreement. It's called different things in other states. Like in Ohio, it's called a restrictive covenants. And I think in Alabama or Georgia, one of the two, it's land use restriction covenants. So it has a few different titles, but just know that it's the land use restrictions.
Right.
So it's restricting what that land can be used for, and what you can use the apartment community for, because it dictates many things. But what I use it for, or what I review it for, is to determine the amount of units within that apartment community that are affordable. Because sometimes you can do mixed income. You can have market rate units and low income housing units. And so your LURA will tell you what the percentage is that's low income. It'll also dictate if there are any deeper skewed rent restrictions. So if an owner went in and applied for tax credits, and in that year they were incentivizing 20% of AMI, 30% of AMI, 40%, any of those, the land use restriction agreements will tell you the number of units that are restricted at this percentage level. And so that's really important. And then on top of that, it also dictates the initial compliance period and how long the extended use period is. So if the owner agreed to, let's say, 5 additional years on their affordability period, then the LURA would tell you if that 5 additional years is added on to the initial compliance period, or if it's added on to the back end to the affordable or extended use period. So that's actually the very first document I request when I get a client saying, hey, I'm thinking about taking this property through QC.
Yeah.
I say, cool, send me your LURA, and then send me your 8609s, which we can talk about those. But the LURA will tell me right away if a property is QC eligible and what year it'll be QC eligible in. I don't know the exact year from that, but I can kind of get an idea of when the tax credits were allocated. But that's one of the most important documents that governs these LIHTC properties. So it's very important.
Yeah. So let's kind of talk about, when you have clients call you and go, hey, I'm thinking about running this through, right?
Mm-hmm.
And I remember from our call, if I remember partially right, is you were like, okay, and you send us like a list of items that they're going to need to be,
Yeah.
And one of the things I saw is, man, they better have kept real good financial records and everything else, or they're toast.
Right, exactly. And I can't tell you how many times someone calls me up saying, hey, I'm going to buy this property and I want to take it through QC. And I say, all right, well, let's look at all the documents that you have. And the property's exchanged hands multiple times. No one thought to get all the records that they need. So there's actually no way to even start the QC process, because it is an extensive list. And the reason why, and I'll get into the documents that you have to request, but the formula, like I mentioned earlier, that's dictated by IRC Section 42, it actually requires us to look through tax returns and financial statements for every single year since a property was placed in service. And actually since inception. So since the partnership was created, which is usually 2 years before the property is placed in service. So that's extremely important, and we absolutely cannot do the calculation. And that's not just me, that's any CPA firm. We can't do the calculation without that information, because each year impacts the price, impacts the calculation. The first 4 years of tax returns are the most important, because that's when the equity is usually contributed.
Right.
It's not just contributed all up front and given to the owner. They have to meet certain milestones, and then the investor puts the money in. So without that, that's your biggest component within the formula. So if you don't have that information, they can't, a CPA firm can't make it up.
Yeah.
So It's impossible to start without that. But usually when I get a call from a client saying, hey, I want to take a property through QC, whether they own it or not is really important question to ask, because if they don't own it, I want to know how many times it exchanged hands and if someone, the current owner thought to get all the documents. There's been situations where we have a really good relationship with an investor or with an owner that owned the property originally, so we can pull on those contacts to get that information. But for the most part, it's pretty much impossible if the person didn't get it from the original owner. Something I didn't mention, part of these properties, their annual compliance requirements, obviously you have to file a tax return. That's a given. Yep. But each investor and each lender requires audited financial statements. So that's not really a concern as far as getting that information, or as far as whether or not that information is available. It's available. It's just a matter of if who owns it now and if they had thought to get that information from the original owner. Yeah. So.
Well, and I was going to mention about the audit, because we're dealing with one Litech owner right now who said, yeah, I have some properties and I'd be willing to look at offers on these properties and so forth. And so, they sent financials, they sent the LAURA, then they sent all their audited, all their audits,
That's great.
As well. And I was like, wow, okay. So, and that again, this is all, I'm kind of learning as, stuff is being sent to know, okay. So those financials are being audited all the time.
Mm-hmm. Yeah. Not only are they audited annually, but usually the investors want quarterly reporting. So they're being reviewed, extensively, which, it's a great thing though, because we want this program to be successful, and that's part of it. So, and it also keeps the CPA firms employed.
Yeah. So let's go over the documents that they would need to send you.
Yeah. So the two biggest pieces of information, as I mentioned, they need audited financial statements for every single year since the property was placed in service. Tax returns for every single year since inception, since the partnership was created.
So it could be 10, 12, 14, whatever.
It'll be a minimum of 15
right?
years.
Yeah.
Yeah, because
they had 2 years prior, right?
Yes. Yeah, so minimum of 15 years. Tax returns 17 years. If this property is in the 20th year of its compliance period, that's 20 years of information or 19 years of information. So it doesn't end with the compliance period. That doesn't, it doesn't mean that we just need information from year 1 to year 15. If you're in year 20, we need information from year 1 to year 20. Mm-hmm. So it doesn't stop at the end of the compliance period. A lot of people think that, but that's not the case. A lot of times audited financial statements are not required anymore after year 15 because the investor's been bought out and they don't have to report to the state agency like they did before. Yeah. But we still need unaudited financial statements. So still balance sheet and income statement for those years where it wasn't audited. And a lot of people like to ask, my favorite question I get all the time is, well, can I give you one or the other? Well, you can, but it's not going to be to your benefit. Yeah. You want to give me everything. You want to get me the tax returns and the audits because a lot of times if, us at Tidwell Group or EA, we never do this. We never incorrectly prepare a tax return, but it happens. And so if something wasn't reported on a tax return, like a capitalized asset or an equity contribution or something like that, if it wasn't correctly reported on the tax return, then we use the financial statements to back it up or to gain a better understanding, and vice versa. If something's wrong on the financial statements, we can use tax returns to verify that information. So it really is to each owner's advantage to obtain that information so that we can maximize the QC calculation. Yeah. And those are the only two that I mentioned so far, but the rest of the list, there's 6 items. There's a final cost cert, which is something that's prepared when the property is placed in service, and it actually...
so it's final cost certification?
Yes, final cost certification. Yeah. It actually lists out the sources and uses that were used to build the apartment community, and it's what owners use to actually get the tax credits. So you have to send that to the state. state uses it to complete what we call 8609s. It's an IRS form, and that actually starts the tax credits to flow to those investors.
Yeah.
So those are very important documents. So the final cost certification, the IRS form 8609,
Which is what?
with
What
part
is
two completed, that is that's actually the document that says how much depreciable basis this property generated and the tax credits that it actually generated. So that's the start of your entire tax credit reporting. Without that document, because it's signed by both the state and the owner, without that document, tax credits will not begin for that apartment or for that owner. Yeah. So the investor won't get their tax credits if you don't have that. So that's really important. And then the LURA, and then the partnership agreement.
Partnership agreement, yeah. Mm-hmm. Okay. And the partnership agreement is with?
It's the partnership agreement with the investor, with the tax credit investor.
Yep.
And the reason we need that is because it lists out the original equity that was expected to be contributed. And so part of the formula, you're limited to that original equity that was promised. Yeah. If there's things called upward adjusters. So if you build an apartment community and you're expected to generate this, $5 million of tax credit basis, but you actually generate $7 million of tax credit basis, right there, the investor gets more tax credits. And a lot of times if they do that, and this depends on the types of tax credits, but if you generate more than what they expected, they'll give you more equity, and that's called an upward adjuster. And the QC formula does not allow upward adjusters within the formula, within the calculation.
So I'm sure this happens, but how many times when somebody calls you and you go over, okay, here's the 6 items I need, how many of them go, I don't have those?
98%. Especially the guys that
I didn't think it would be that high.
Oh, yeah. Especially the guys that are market rate guys, and they call me and they say, tell me about this QC thing. And then I learned my lesson real quick to start off by saying, okay, do you actually have a property that you're looking at?
Yeah.
Yes. Or have you been able to obtain these documents? No. Okay. Well, go try to find those documents and then come back and talk to me.
Yeah. I didn't expect it to be 98%.
It's a lot. Unless it's someone that's, that
has bought and done this before.
Yes.
Yeah.
Then I usually don't have to break it to them like that. But for the most part, it's a majority of my calls.
So on the front end, how many of the developers how many of them know they need to keep all of this information and from day one?
Well, the owners, they're actually required to keep it. They have to.
Yep.
It's part of their, the tax credit compliance. You keep all your financials. So that's not usually a problem. But the problem is when someone buys it.
So that may not been turned over, or they didn't know to ask for it.
That's what the problem is. So if the apartment community sells, within that 15 years, or even at the end of the 15 years, unless someone specifically says, I want this information, an owner is not going to just give you 15 years of tax returns and financial information, right?
Right.
So you specifically have to request it through your due diligence period. And when it's not requested and then someone tries to sell it again as a QC property, that's when it becomes an issue because you have to go back to the original owner and you have to get that information, which is very possible. We've done it a lot, but it can be very expensive and very time consuming because, no one's just going to give you information for free these days.
Yeah.
And money talks. That's what I tell everybody.
So I got that. That's noted.
Yeah.
Right there, right? So basically what I'm hearing too is, so you work with people that may be calling you and going, hey, Amy, I'm looking at buying this property. Mm-hmm. But also I'm sure you work with those that already own the property, right? To say, okay, hey, I'm approaching, year 13, 14, and I'm looking at possibly taking this, through the QC process, or what do you think if I, is now a good time to sell, or what? I mean, kind of tell me when people mainly engage you.
Yeah.
Maybe it's through the whole process. I don't know, but
Yeah, I mean,
yeah.
I get engaged on many different levels, you know, even if it's just to answer these kinds of questions. You know, if people are calling me up every day, every week, asking me random questions, I get engaged to do that.
Yeah.
So there's a span of that. But let's talk about if someone already owns a property, whether they're the original owner or not. You know, a lot of times if I get a call from an original owner, that is, you know, whether they're my client, existing client or not, a lot of times their concern is they don't want to take a property through QC because, especially in a state like Tennessee, they actually disincentivize owners going through QC, because if you have a property currently in the 1-year QC period, the marketing period, they will deduct points from future tax credit applications. So that's their way of, you know,
Wanting you to keep it in.
yes, getting owners. And I guess we need to back up about that. QC is widely disliked
Yeah.
by state housing authorities because, you know, they look at it as taking properties out of the affordable housing stock.
Right.
Well, I can definitely argue that, because a lot of times these properties do not qualify for new tax credits. So when you hit year 15, what's your option?
Yeah.
You don't have one. You know, and you don't generate enough cash flow to refinance because your rent is restricted. You know, the IRS, or I guess HUD, puts out the rent levels each year, and that's the maximum tax credit rent that you can charge someone. So, you know, they don't generate enough cash flow. They're not supposed to. They're supposed to break even. They're supposed to barely make cash flow. And a lot of times they don't generate enough to refinance. They can't, you know, recapitalize their property. So they just go into deferred maintenance. And then, you know, the poor tenants that live there no longer have a beautiful community, and they still need to maintain, the owner still needs to maintain compliance within that 15 years, but it's a lot less than what it was the first 15 years.
Yep.
So there isn't, you know, the strict requirements of maintaining that property like there was in the first 15 years. So there's no other option. So a lot of times these owners take these properties through QC strictly just to get the rent restrictions off of them so that they can raise the rent a little bit to refinance them. Yeah. And those are the clients I love working with. I don't love the idea of taking a property through QC to remove the rent restrictions and then someone selling it for a $20 million profit. I don't know if that would happen here, but that's not the area that I want to work in. But it does happen. But anyways, I'm sorry, what was the original question?
Yeah. No, we talked about when they engage you, right?
Yes.
Yeah.
Okay, so that's a lot of existing owners or original owners won't take their properties to QC for that reason. Yep. They do, but it's not as common. Right. But when I usually get a call from an owner that recently purchased a property and they want to take it through QC, if they're not well-versed in the program, then usually we hit a roadblock there because they didn't get all the information they needed. But if they did, I actually usually ask my clients to call me before they purchase the property because I want to look at the QC price and make sure that they're not paying more for it than they need to. I had a client very recently, and I hope he doesn't listen to this podcast, but I had a client very recently that had purchased a property in Tennessee, and I just completed a calculation for him. He purchased the property for about $5 million more than what the QC price is calculating.
Ouch.
Yeah. So I had to break the news to him last week and let him know, sorry, it's not a good idea to take this property through QC because here's the calculation and it's not great. And the reason for that is because within that formula, you have to deduct from the QC price the distributions and related party fee payments that were paid out to the partners. You have to discount the price for those payments, for those payouts. And 2 owners before him, they had refinanced the property and they were distributing a lot of money from this property, which they can do. That's not illegal or anything. Right. They're certainly allowed to do that within the parameters, but it impacts the pricing very negatively. Yeah. And it was about, I think, $3.3 million that I had to reduce the price by. Not to mention he paid too much for the property in general, but.
So you had to say to him nicely, next time before you buy, give me a call.
Yes. Yes. Sometimes people have to learn the hard way, but
Yeah.
I guess as long as they learn.
Yeah. So for brokers like me, when's the best time for us to have, if we have clients or people looking to buy, something we have, when's the best time for us to say, you know what, you need to call my friend Amie?
Yeah. During the due diligence period.
Okay.
Because at that point, you should be able to obtain all the information that you need. So all the financial statements, tax returns, all that stuff. And in fact, if you can't obtain that during due diligence, I would say don't move forward with it, because if that's your intent is to take it through QC, you 100% need that information. And then so what I do with my formulas, and this is usually when I get engaged, I calculate a estimate is what I call it. It's not an estimate. I go through every document and actually do a full-blown calculation. I only call it an estimate because it doesn't go through the full review process that's required at the CPA firm. So I go through that, and I actually take into consideration the debt that you're going to put on it and a few other assumptions, because the calculation is done as of a moment in time, just like a balance sheet. So if we calculate it as of 12/31/24, and then you go and you buy it 6/30/2025, it's going to change from 12/31/24 to 6/30/25. So any good CPA firm will take that into consideration, and they'll actually take the debt and a few other items into consideration, so that we estimate the price. It's not just based on the moment in time, because it can change drastically. Yeah.
Interesting.
Yeah.
So, yeah.
And then what I usually say is take that QC price, compare it to the fair market value or to what you're going to purchase it for. Be okay with that return on your investment, because if it does sell, then you're going to want that. But also, that might be grounds for negotiating your purchase price, because if it's too high, there's not enough of a return, then you might not want to buy that property.
Yeah. Okay. So what are some? I know there's a million other topics we can talk to, but so what are some of the other items that you think our listeners or investors really need to know, to understand, that you want to share with them?
That QC is a great option for creating workforce housing.
Yeah.
I don't know if that's a time to plug that, but
no, go for it.
they're trying to come up with a middle income tax credit right now, and it's to target that 80 to 120% AMI. Well, that's amazing, and that would be great for
Between the 80 and 100, or the 60 to 80?
80 to 120%.
Okay.
Because that's what the middle income.
Yeah.
Right.
Okay.
And those people also need housing, and they are also subject to the insane market rate prices right now. So affordable housing, or historically low income housing, once you get to that year 15, you remove the restrictions. Like I said before, you refinance, and then you can rent to people that are between 80 and 120%, which is what a lot of people refer to as workforce housing. And it is a great tool for that. I would love to see more state agencies actually, being, I guess, accepting of that, and not just saying, don't do QC, this is terrible for our industry. Because, rather than creating a new tax credit and, creating this whole process all over again, why can't we just use the affordable housing stock that is already out there that, needs recapitalized and needs some love, because it's 15 years old.
Yeah.
Anything that's built 15 years ago needs a little loving, right? Yeah. So I think that's really important to point out to people, and something I've been trying to spread across the industry. It doesn't have to be a bad thing. We can use it for good.
Right. Yeah. So and I'm trying to remember the term you called it, when it gets ready to maybe go transition, right, to where there's the 3-year
decontrol period.
Decontrol period. There you go. Thank you.
Mm-hmm.
So how, per year, how many of those can be rented at market?
It's all about your population. So I guess you asked if anything else I wanted to say. I do want to note to anyone that's interested in this process, please remember there are human beings in your apartment communities.
Yep.
If you buy a low-income housing apartment community, it could be, 55 and over. So it could be seniors that don't relocate very easily. Also, I don't know, I guess just me as another human, thinking about other humans, I would never want to kick an older person out of their apartment community just because I want to rent that unit for a lot more money. So please keep that in mind if that is something that that the investors or whoever is interested in. But the decontrol period, so anybody that is in those in those apartment units when that 1 year period ends and the decontrol period starts, those people are grandfathered in for that full 3 years. So if they don't leave, then you can't increase their rent. After the 3 year period, you can, but you can't evict them because that's what you want to use their unit for. And so so they're grandfathered in for the full 3 years. When they leave, that's when you can.
That's when you can.
Yeah, but any vacant units any units that become vacant during the 1 year marketing period, I usually tell my clients to go ahead and keep vacant if they can, because that will those units will be available to rent at market rate when the 1 year period is over.
Yeah.
Yep.
Okay. All right. Any other items? So believe it or not, we usually run this podcast an hour, and an hour goes by really quick.
Yeah, it does.
As we know, because we're at the hour mark already.
Okay.
Believe it or not, but I want to give you time to say any last words. I know I got you speaking at another event here later on this afternoon too, but to share more of this information.
Yeah, no, I think I already got on my soapbox a little bit about the middle income and about how it can be used for good. QC. So no, I think I'm good.
When do you think that? Do you think that'll get passed?
I'm not sure. Actually, I haven't been keeping up on all the legislation that's been proposed lately.
Yeah.
That's just been something that has been introduced in the past and has been, talked about within my industry, but I actually don't know where it stands. So, but I know it's something that we definitely want and would be great for the middle income and for our industry. But I actually don't know where it stands right now.
Yeah. So how much of your time is spent with developers who are getting ready to look at building this stuff? Compared
I would say,
to those that already own it or those that are looking to own it?
I would say, well, within my team, I help owners get through the construction process.
Yeah.
I help them prepare their construction draws and submit them to the banks. So I kind of work on that accounting piece on that side of it. So I would say about 40% of my time is probably spent on new construction or new tax credit allocations, whereas 60% is spent on qualified contracts and helping owners buy out investors. Yeah. So that's another topic we could have a whole podcast about one day.
Yeah. Is owners buying out their investors?
Yes. Yes. I'll send you a few articles. It's a wild topic.
Wow.
Especially when you add in aggregators.
Now you have me really curious.
Yeah. Well, hopefully that's a little tidbit for viewers.
Yeah. That is really interesting.
Yeah, it can get really, really complicated, really messy, and really litigious. So.
Okay.
Yeah.
Yeah. Nobody likes the litigious word.
Except for the butt heads, bringing on the litigation.
Yeah.
They love it.
Yeah. Well.
Yeah.
Maybe an attorney would, but.
Exactly.
But I'm assuming the other folks, not necessarily. I wouldn't think
right.
Anyway.
No, they don't.
Yeah.
Because it's the owners that are being sued. So.
All right. So, kind of wrap things up. We're gonna put your contact information. It'll be on the podcast. But if you want to say, how is the best way for our listeners to contact you?
Sure. Best way to contact me would be through email, amy.gray@EisnerAmper.com.
And Amie is spelled?
It's AMIEGRAY. And that's the best way to contact me. I'll respond when I can.
Yeah. And if you didn't get that, you can reach out to me and I'll pass along our email address for you. So
thank you.
Yeah. So, well, I really appreciate you. So number one, I appreciate you coming all the way from Illinois to be on the podcast
Sure.
today, and then to also be presenting this afternoon here to a group of investors. So I appreciate you taking the time to come. I feel very honored to have you here, and I just knew from our conversation, and not only Brandon's recommendation, but our conversation is, I was like, okay, here's an expert when it comes to affordable housing, and this. So I love having experts on that can explain it, because I might maybe 7 now,
Yeah,
but
you think?
it would be we'd have a lot of discussions before I even felt comfortable talking
Well,
about it.
like I said, it's 20 years in for me, and I learn
Yeah.
something new every day. So it's always something new. But thank you so much for having me. I'm honored to be here.
Yeah. Thanks again. And so for all of our listeners, we appreciate it again. It'll be podcast will be dropped in probably a couple weeks here, so be on the lookout for that. And until next time, thanks for listening.
Thank you.